Hi everyone. About 4 months ago, I put together a video asking if we were in a real estate bubble. We got a ton of views on that video and there were some pretty heated responses in that comment section. So 4 months later, we're now asking, has the real estate bubble popped? Stick around as we try to answer that question and what you might want to do about it.
Maybe freezing outside, but Canada's housing market, red hot.
Why have housing prices gone up 32%?
The inflation rate in this country with another record high.
Very discouraging to see the prices creep up faster and faster, and I don't think anybody's income is being accommodated or adjusted.
There is pain at the pumps in Vancouver, where gas is more than $1.80 a litre.
Canada's inflation rate, or the rate of price increases, hit a 3-decade high in December.
Welcome back. I'm Andy from Sweet Additions, where we help homeowners and investors build better homes while creating lasting wealth with legal additional suites. Download our free guides at www.sweetadditions.com to get started. And please do us a huge favor by giving us a thumbs up on this video and subscribing to this channel so we can get more content out. Okay, so we made it clear before that most likely we're in some sort of a housing bubble. Now, for those of you that disagree with me, consider this. Regardless of the actual dollar value of real estate, you have to agree that it's entirely abnormal for the real estate market to have 30% year-over-year returns. Even if things don't change fundamentally, nothing goes up in a straight line, just like nothing goes down in a straight line either. Even though I did suggest that we were in a bubble, I also left the caveat that we actually have no idea if this bubble will continue or if it's going to pop. I know, that doesn't help you much. I'm sorry, my crystal ball is a bit cloudy. We might need to call up Miss Cleo for some answers.
Dave Chappelle's educated guest line.
Many who feel that prices are entirely justified are pointing towards supply constraints, which are real, and a large demand as a result of more people moving into the GTA. Although I do agree that those external factors play a major role in the price run-up, I have stated before that I believe the biggest culprit is devalued dollars and cheap credit. This is because of extremely loose fiscal and monetary policy in the past 20 years, which have accelerated into overdrive in the past 2 years. Consider that a huge percentage of all the money that has been created occurred in the past 2 years in Canada. This is the same for much of the Western world. I hesitate to believe that we would get the same price run-up if interest rates were historically, quote-unquote, normal at, say, 5%. Despite our large and rapidly increasing population, I feel that if the interest rate was set at 5%, the insane demand we currently have would dry up pretty quickly. Additionally, the official inflation rate in Canada is at a 30-year high at 5.1%. If you're in agreement that a 5% increase would slow down price growth and tame inflation, the answer is simple. Let's simply raise it to that amount and everyone would have affordable housing, right? Unfortunately, it's not that easy. It seems that the current narrative is that with the high inflation in the economy, as well as the high cost of housing, the policymakers are going to come in with huge rate hikes to save the day. At the end of last year, Scotiabank indicated the central bank would raise interest rates 8 times by the end of 2023. These are the same policymakers that told us a year and a half ago that interest rates would remain low for a very long time, and encourage Canadians not to worry and keep borrowing and investing more to drive the economy.
Interest rates are very low, and they're going to be there for a long time.
To me, a long time does not mean a year and a half. And that they're not even thinking about raising rates. I did not stutter there. Watch this clip.
We're not even thinking about raising rates.
In fairness, that last one was the US Fed Chairman Jerome Powell, not the Canadian Central Bank, but you get the idea. I believe the Bank of Canada is not really making its own decisions, but following what the US Fed is doing. So borrowed and leveraged is what we did, and now they want it to stop. Which one do you want us to do? Tell us.
Are you going to tell us?
Okay, they're not going to tell us. So now that the economy went deeper into leverage, it's obvious it's a bit out of control. Average GTA real estate prices in February 2022 went up 1.33 million from 1.04 million in February 2021. In all of Canada, this figure was 21% year over year from January last year to this year. Officially, inflation is 5.1% in Canada as of January, and new data came out in the US that's 7.9%. Gas prices are at a record high at around $1.80. Because of the rapid inflation that we're seeing, the narrative we hear is that they're going to rein things in by increasing the interest rates and send a message to those irresponsible and over-indebted households. And oh yeah, teach a lesson to those evil real estate developers and speculators. And so it has begun. In the Bank of Canada's March meeting, they increased rates by an additional 0.25% for a grand total of 0.5%. So if they're going to do what it takes to tame inflation, which as I mentioned means they would have to raise rates up by several percentage points. Now most people believe this is what's going to happen, but I personally don't buy it. Why is that, you ask? The reason is simple. It's math. The current Canadian federal debt sits around 1.2 trillion. Assuming an interest rate increase to just 3%, this means the federal government would have $36 billion in just annual interest payments alone on the bonds that are allowed. Now, obviously, there would be some variations in the rate depending on the length of the bonds, but this will be a rough ballpark. Now, how do you think they're going to pay for this? You got it. And what does that do? Bingo. And this doesn't even include our provincial debts. This is the world that we live in right now. The numbers are truly staggering. Now, if you look at the entire global debt market, it's $300 trillion with a T. A 3% interest rate increase means $9 trillion in interest payments. These numbers are hard to imagine. To help you understand this number, if you converted dollars to seconds, a million would be 11 days, a billion would be 31 years, and a trillion would be, wait for it, 31,000 years. That's a very long time. The other thing is that if interest rates ever got to 3%, it would probably entirely crash the economy to the point that there would be no tax revenue at all for the government to collect from. And oh yeah, there's a war happening. Of course, this is an incredibly sad humanitarian crisis. It's also going to add fuel to the fire of already sky-high oil and gasoline prices. Please pardon the pun. As a matter of fact, this is probably going to be the excuse for them to ease off the rate increases. This to me seems an awful lot like the playbook that has been in place for the past decade. Tell everyone the rates are going up, drive the market down a bit, and then cite external factors for why they can't keep raising it. I'm going to try to not fall for it this time. But hey, I could be entirely wrong, and they could surprise me by jacking rates up to levels that occurred in the 1980s, crash the economy and the government at the same time. Now, given what we've seen throughout history, it's just unlikely. It's always much easier just to print more money and allow inflation to run red hot. Don't get me wrong, I think more interest rates are coming, possibly even up to 2%. There's a report by a macroeconomic researcher by the name of David Doyle who argues that an increased interest rate to a mere 1.5% today is equivalent to 10 to 21% we saw in the 1980s. This is because we're so much more levered today than we were 40 years ago. Back then, the federal debt was around $80 billion, and that debt has ballooned 1,500% to now $1.2 trillion. In the US, the narrative of increased rates has certainly put a damper on the stock market, as tightening has already been priced into the market. So the question is, ultimately, will this affect real estate in Canada? I think that it's possible and even likely if you ask for my opinion. We're hearing anecdotally that at the current moment, properties aren't selling at the insane prices even just from a month ago. Warehouses were getting 20 offers just a few weeks ago, now are only getting a couple of offers or none at all. This is probably a good thing and maybe similar to what occurred a year ago. We had a frenzy in January and February of 2021 and things cooled down a bit in March. So as interest rate bump ups continue to happen in the next year or two, at some point I think it's going to be so much pain, they're going to have to change course and loosen things up again. This to me means more of the same when it comes to real estate. In the meantime, with just a 0.25% increase, nothing fundamentally changes. But the narrative of tightening is here and can really cause the market to stall or even pull back, possibly like what happened in 2017 when they introduced the foreign buyers tax in Ontario. The funny thing is, if the bubble does pop and the market crashes by 30%, which is massive, it basically only takes us back to around the beginning of last year. These are truly weird times. In any case, I urge you all to be super cautious in this environment. Don't over leverage and don't overpay. Take any emotion out of the equation if you're in the home buying process. Now more than ever, it's important to focus on forced value strategies rather than expect that our houses are going to go up by $50,000 per month. This is not investment advice, just my opinion. Do what works for you. It may even be worth sitting on the sidelines a bit and focusing on the forced value appreciation strategies that we discussed before on any properties that you currently own. These include cosmetic improvements, second suites, garden suites, and possibly small-scale infill development opportunities. Now, if you're looking to buy, apply our 10 strategies to increase your chances of success. You can check out what those things are in our first real estate bubble video where we broke down these strategies. It all comes down to utilizing everything that is within your own control as much as possible, such as understanding market dynamics at a local level, finding an ideal property that you can transform into its highest and best use, and building valuable relations in a particular market. Okay, so that's all I have for you today. In summary, I believe a few more rate hikes are coming, but after that, we'll probably start seeing cracks and they will be forced to loosen things up again. But because of this tightening narrative, it might be just enough to slow down this runaway freight train that is the Canadian property market, especially in Toronto and Vancouver. That's my guess, but of course, I could be wrong. So what are your thoughts? Do you think the market is going to continue to go up, stay flat, or go the other way? And what are your reasons for that? Share your questions and comments below. I'll be sure to answer everyone. Again, please do me a huge favor by liking this video, subscribing to this channel if you haven't done so already, share this with a friend. Thank you so much for watching to the end. Keep creating better homes while generating wealth. We'll see you in the next video. Hey guys, thank you so much for tuning in. If you want to learn more about investing in housing densification and how you can get involved, hit that subscribe button. I put together a beginner's guide and also a handy 8-point checklist that covers everything you need to know about adding a legal second suite. We cover important bylaw and building code requirements for cities in Ontario and all the design considerations you need to make to successfully complete your project. You can download that through the link in the description below. Until next time, to your success.